Sole proprietorship versus LLC. Here's what you need to know. When embarking on the journey of establishing a fresh small business, initiating an online store or commencing a freelance endeavor is a crucial decision arises. Should you opt for an LLC or a sole proprietorship as your legal structure, this choice between two distinct business models can profoundly impact how you operate your enterprise, encompassing legal, tax, and managerial aspects. Here's a comprehensive exploration of what a sole proprietorships and LLC entail, along with guidance on selecting the optimal option aligned seamlessly with your specific requirements. Sole proprietorships and limited liability companies are two predominant forms that businesses adopt, especially when we consider individual entrepreneurs or small-scale enterprises. While the former boasts simplicity with minimalistic documentation, the latter comes with initial requirement of documentation and might involve some associated costs. However, the long-term benefits that LLC offers, like legal protection and potential tax incentives, might take this initial hassle worthwhile. Delving deeper, let's understand the core characteristics and differentiating factors between a sole proprietorships and an LLC. The definition of a sole proprietorship represents an unincorporated business solely owned and managed by an individual. Essentially, if you're conducting a business without officially registering under any structure like an LLC, you're by default a sole proprietor. In this structure, there isn't a distinct separation between personal and business assets or expenses. It entails that the owner, the sole proprietor, shoulders the responsibility for all business-related debt and financial obligations. A significant feature of the sole proprietorship model is that it allows only one owner. Transitioning to a partnership model requires the introduction of an additional partner, converting the business structure into a general partnership. Sole proprietorship finds its fit among individuals engaging in extensive contractual work. This includes, but isn't limited to, freelancers, consultants, and personal trainers. This format proves especially beneficial for novices in the business realm or those whose profit margins don't warrant the LLC expenses. The decision to opt for this structure hinges largely on factors like income, the nature of the business, and an individual managerial inclination. An LLC or limited liability company is a distinct business entity birthed from formal state filings. The ownership of an LLC can rest with a single individual or multiple stakeholders. An LLC stands separate from its owners in legal terms. This translates to your assets being immune to business creditors in case of litigations or inability of the business to clear its dues. Moreover, the financial downturn of an LLC doesn't ripple into the owner's finances. Additionally, owning an LLC can shield you from potential liabilities arising from employees' actions. While single-member LLC undergo taxation akin to sole proprietorship by default, there is a provision to opt for S corporation or C corporation tax structures. This malleability in tax structure allows LLC owners to cherry-pick the most economically viable tax bracket suited to their business model. For many, this versatile taxation capability serves as a compelling reason to champion the LLC route. Considering transitioning from a sole proprietorship to an LLC, here's some indicators that might tip the scales in favor. If you harbor plans to induct more owners into your business venture, the transition is smoother with an LLC. An innate desire to shield personal assets from potential financial or legal entanglements, i.e. the bouquet of local, state, or federal tax perks that accompany an LLC formation. Charting the course of your business as an LLC can pave the path for potential growth, furnish liability protection, and usher in tax benefits. Many entrepreneurs consider this switch when their earnings reach a pivotal point, making the added paperwork and associated costs justifiable. Given the variation in regulations across state and business sectors, consulting an accountant and analyzing the tax implications across both structures becomes imperative. Choosing the right business structure is vital for entrepreneurs. This article delves into differences between running a business as a sole proprietorship versus an LLC, examining aspects like financial distribution, implication, and establishment procedures. Sole proprietor, your business identity isn't distinct from your identity. While there are no strict requirements to keep personal and business finance separate, having a dedicated business bank account can simplify tax preparations by delineating business expenses. An LLC mandates a clear distinction between personal and business finances. This means having separate business accounts and signing business-related documents in the company's name. Maintaining this demarcation ensures that the liability protection offered by an LLC remains intact, as it underlines the separate identity of the business. Sole proprietors are self-employed individuals. Report your business earnings and outgoings on Schedule C of your tax declaration. This also means you pay personal income tax on your profits and shoulder your own Social Security and Medicare taxes, commonly termed self-employment taxes. Owners of single-member LLCs are by default considered similar to self-employed sole proprietors for tax purposes. However, LLCs can opt for corporate taxation. Under this, an LLC owner can be employee of their business, offering potential savings on self-employment taxes and increased retirement savings opportunities. As profits increase, it's prudent to consult a seasoned accountant to discern the optimal tax structure for your enterprise. Operating as an LLC often adds a layer of credibility to a business. Payments are processed under the company name, and the LLC tagging your business name can offer a professional sheen. Additionally, an LLC can foster business credit, a feat challenging for sole proprietors. The The costs and procedures for setting up either a sole proprietorship or an LLC differ based on state regulations. There are numerous resources and services available that streamline the LLC registration process, making it more accessible to entrepreneurs. While LLC might offer tax advantages and unavailable to sole proprietors, these benefits are context specific. The feasibility of an LLC from a tax perspective hinges on various factors such as profit margins, expenses, and business nature. Transitioning is possible by submitting an LLC application to relevant state authorities like the Secretary of State or Business Bureau. Yes, but involves dissolving the LLC first. This entails obtaining member approvals, notifying creditors, setting outstanding bills, filling requisite tax documents, transferring assets, and more. Establishing an LLC involves initial formation fees, which can range from $50 to several $100s depending on the state. Additional expenses might include legal fees, registering agent service charges, and recurring state-specific fees or taxes. Registering a business name safeguards intellectual property. To understand this process better, one can refer to resources on a trademark registration. An LLC is created by submitting the necessary paperwork to the state by paying the filing fee. State-specific information can be accessed via respective website or sought from professional in the domain.